Afternoon, hello and welcome to the 2:30 Factor. It's the last trading session for the week, going to a weekend and of course come back next week with just 5 days to go for election counting. Ashu, I think that's what's overhang on the market, the broader overhang on the market. All right, let's actually bring in our first guest here on the 2:30 Factor and get a perspective on the fundamentals of the market going. Mohit Mirchandani is head equity at Taurus Mutual Fund. Mohit, afternoon, welcome to the show. Just plain simple profit taking, and do you see this, as a welcome sign that you've had this unabated sort of a run, unbroken run? A little bit of money off the table at a time like this perhaps might not be all that bad.
Absolutely. I just think this is healthy for the market. We need these kind of pauses, consolidations, corrections actually, because what's happening now, making money is becoming too easy. Everybody is jumping in and riding it higher. You do need some of these shocks to shake out weaker hands. And so I think a couple of days like this, or even if we get a week which scares a lot of people off, is not a bad idea at all. What I suspect is going on here is, although Asia is strong and Europe is good, and I just think our markets were one of the best performers anyway in this mega run we've had so far, and so it's logical that before what is perceived as a big deal in the market, the election outcome, some people are just taking money off the table. So that I think Asia being up and we being down, I think is attributed to profit taking before the next week.
Mohit, afternoon, this is Ashu joining from the Delhi studio. Help us understand what's been the extent of mutual fund participation in the recent rally that we have seen, because the sense you get from the traders and from the brokerages out there is perhaps the FI-led rally, the mutual funds have not been able to adequately cash in on what's happened in the last 1 month or 1.5 months since March 9th. And also, if you can help us understand, as far as the industry is concerned, what are the current cash levels? Have perhaps the funds gone ahead and aggressively invested in the recent up move, or they're still sitting on the sidelines waiting for the rally to perhaps taper off and then perhaps take a fresh look?
Okay, I think that's two questions. First, have funds participated? My feeling is not to the extent we would have liked. Even some of the other fund managers I talked to, a lot of us did miss at least the initial part of the rally, and a few of us jumped in a little later after we got that confirmed breakout from 3150. I think that's when a lot of funds went ahead and deployed some money. But having said that, I know a lot of funds are still sitting on cash, waiting to buy dips, which just doesn't seem to come.
Mohit, the obvious question for a lot of people is how much or perhaps what form will the fall or correction take? What's your sense? 10% is a reasonable and a fair number, about 300, 350 points back to about 3200 levels on the Nifty?
Oh yeah, I frankly I think if on more on the technical front now, that 3150 level that we broke out of, I think will serve as a very good support. So if we do get down to that level, I could be reasonably confident that most fund managers will go ahead and be deployed for the most part. The question is timing this correction. A lot of us have thought that the correction should have come last week or the week before. So I think many of us have not been able to gauge when this correction should come. Now the general feeling on the street is that the election outcome might create some kind of a knee-jerk reaction, which gives all of us a good buying opportunity. I somehow think the street will not oblige. Markets will do exactly what we all do not want. So I think we will not get to that 3150 level now as a result of any knee-jerk reaction. That might be a little more subdued just because there's too much money waiting on the sideline to buy the dips. So I think if we get a knee-jerk reaction now, that I suspect will probably stem at about 3400 on a worst case scenario, at which point a lot of money will come in again. What I suspect will happen is we've made this initial burst. We'll probably hang around here for some time, and then once you know, we've come off from the oversold levels. We've now adjusted fundamentally on the valuation front. But now we've just got to wait for those earnings to trickle in, which I think will only happen Q3 and Q4, which will begin to justify the move we've had in the market. So I suspect we'll just drift for a while. Once we get the knee-jerk reaction and money comes in, and we'll probably go back to 38, 3900, maybe even 4000, who knows. But then once we get that big move down and then up, we might just drift for a while, waiting for time to catch up, waiting for our earnings to catch up.
Right. Mohit, you know, this particular leg of the up move has been just led by foreign investors, foreign institutional investors. Domestic mutual funds have been just spectators, if I may so use that word. You know, it's very evident from the underperformance that most mutual funds have had for the last 4 months, you know, this particular year. My question is, if a little bit of that money starts to come into the market to buy stocks, and you know, foreign investors for whatever reason start to pull back a little bit, or the pace of the inflow start to slow down a little bit, do you think you know, mutual funds will be able to support the market at the current levels? The level of interest, the level of activity would be the same with a lesser FII interest in Indian stocks?
I doubt that. Frankly, I do not think the domestic mutual fund industry alone can counter any FII selling, if there is. You know, and even if FII's flows dry up, we have domestic institutions which I think are sizable. And so I think between domestic institutions and FIIs, we could probably support the market. But mutual funds alone, I don't think can do that. But my confidence about, you know, the worst being over, and maybe this is the start. We're seeing a lot of risk appetite returning. A lot of the credit spreads are narrowing. Risky assets, I mean, risk-free assets are giving you nothing today. Whether it's in the US, even in India, your fixed deposit rates or your government treasuries don't give you anything. So there's no choice but to start looking at riskier assets. On top of that, you have money being thrown in, you know, by governments across the world. So that money is going to find its way to risky assets again, and that's where we suspect equities and commodities and real estate are probably going to find favor again. Now, I'm not saying this is going to be one of those, you know, healthy moves, but it's a move nonetheless which we've got to capture. We're probably just creating another bubble by throwing all this money into the system across the world. But as fund managers, we've got to capture these moves, knowing fully well that you know, this might not be a very healthy move.
Right, Mohit, thanks so much for joining us this afternoon on NDTV Profit and sharing with us your views and opinions on the market. So definitely, Mohit.
That's it here on the 2:30 Factor. Thanks so much for watching. Good week, bad day, but then you give some, you get some. That's the rule of the market. That's the way the market trades. Have a nice weekend. We're going to see you back on Monday morning.
Well, very aptly put by Prashant. But again, all eyes would be on the outcome of elections. That's a big trigger point as far as the next week is concerned.